Indicators should be used in combination with other technical analysis tools and never as a single signal into trade. Trading indicators are mathematical calculations which are plotted as lines or bars on a price chart and can be helpful to identify certain signals and trends within the market. We talked a little bit about indicators ever so slightly, and there was mentioned that most of indicators are made many years ago and are not relevant these days, because markets changed many times from the day those indicators was invented. However, there are some of those which are useful even now to help identify the best possible chance of market movement. There is no reason to put bunch of indicators on your trading screen to look better. Important to add those tools to your trading chart which brings value to your trading statistics. If there is some indicator on your trading chart just for reason to be there, then either delete it or use it properly. Keep in mind that indicators should be used correctly. Also, they produce many false signals. Therefore, you must know flaws of indicators. There are 3 indicators which you should use on a daily basis from the very beginning at your trading career. Those are ATR, average true range, volume, and moving averages. Each of them brings different value to your trading and helps to predict further movements. ATR, average true range. The average true range is an indicator that measures market volatility. It is used in technical analysis and shows how much an asset price moves on an average over a given time frame. ATR is one of the most important indicators and should be used all the time. It is key element to set up your expectations of any given day. Important to mark that ATR should be calculated at daily time frame. In any other time frame, it is not relevant because ATR shows how many points on average market moves based on your chart. For us, it's important to know how many points market moves on average on daily basis. Therefore, we are going to use ATR only on a daily time frame. In this way, we already know what to expect from a market. As the name says itself, it is true range. Therefore, to calculate ATR, we need to know ranges of past candles. Daily range is calculated by subtracting candles' highs and low prices, despite whether it was falling or climbing candle. Typically, the ATR calculation is based on past 14 periods. However, market condition changes faster when firstly ATR was introduced. Nowadays market affected so much by news, economical events, and etc. Therefore, it is important to measure recent volatility and use shorter periods of ranges, such as 2 to 10 periods. So we are going to calculate ATR by last 5 periods. Calculation is simple. Take a sum of last 5 daily candle ranges and divide that number by 5, which is period numbers. Let's get to the chart. It is DAX 40 futures market at the daily time frame. To calculate ATR, we need last 5 candle ranges. First one doesn't count, because it is the day for which one we are going to calculate ATR. Do not pay attention, that candle already dropped quite enough. It is already evening, therefore market moved enough for today. But for sake of example, will be good. So 5 past candle ranges. First one, 18915 minus 18678 plus other candle range. 18860 minus 18727 plus another one. 18773 minus 18577 plus another one. 18832 minus 18617 and plus the last one. 18835 minus 18652 and all that number divided by 5 equals to 192 points. You can expect market to move at this current day no more than 192 points. Of course, market could and a lot of times moves more than ATR. But statistically, you have bigger chances to have positive trade if you will not expect that much. You can also insert ATR indicator on your chart. Just do not forget to choose 5 periods. As you can see, at this day, ATR was indeed 192 points as we calculated. When you know ATR, you can calculate it by simple formula. ATR equals previous ATR times number of periods minus 1 plus true range, when the whole number divided by number of periods. Before start trading on a day, you must calculate ATR, in order to know what you can expect from a market at this current day. But why do we need to calculate ATR if indicator doing this job for us? Question is. Well, because as every indicator, ATR has flaws. First one, abnormal candles. Candles which size are approximately 2 size of ATR or more. For example, if our ATR is 192, candles with range with 384 or above would be considered abnormal and shouldn't be included into ATR calculations. Indicator on the chart includes these candles into calculation. Therefore, you have to calculate ATR by your own. Why do not need to include those abnormal candles into ATR? Simple. Because we are increasing our expectations, and to hold higher expectations is always riskier. Approximately 10 to 20% of the whole chart consists of abnormal candles, and to hold higher expectations are less possible. Therefore, we must subtract abnormal candles from ATR calculation in order to have higher possibility by our side. Another thing when it comes to ATR is gaps. Sometimes happening when the market opens with a gap at the price. There is reason behind why this gap happened, but for now it is not important. And when gap appears, your ATR doesn't start to count from a daily candle opening price. You have to count ATR from a previous day closing price. Usually, gaps intend to close, meaning price comes to the area of the previous day candle closing price to close the gap. Not always, of course. Sometimes, after gap, comes into the market a lot of buying or selling pressure, and market continues to rise or fall. But bigger chances exist for gap to be closed. Therefore, at these times, act accordingly. Let's take a look at the chart. Same market. Let's take a closer look. As you can see, this big falling candle is way bigger than all other around, with range over 400, and that one you shouldn't include into your ATR. Same goes to this candle. Even visually it's obvious that it is way bigger than any other around. Another candle with short body and long tail. It is also abnormal candle, because candle range represents its distance between high and low, and not the body. Let's take a closer look at this area. As you can see, market opened with a gap, so we are not going to calculate ATR from this candle opening price. Instead, ATR would be started from this candle closing price, right here. Market continues to climb, but that is not the most important part. Important is to follow rules and have a bigger chances by our side. Even though, later as you can see, gap were closed. That happened with this abnormal long tail candle. For me, there are no questions why that happened already. Another important rule. 60 to 70% rule. When ATR moves more than 60% at the day, do not take trade into trend. Reason why is simple. Because there are less chances that your trade will be positive. For example, ATR is 200 and market opens at the price of 18,000. Market climbs up to 18130. It is already 65% up of ATR. Therefore, I'm not going to take long trades anymore on this day, unless market falls a bit. At markets where is no any market opening time, ATR tracking in terms of price starts at daily candle opening price. But with any other market, it starts from market opening time. For example, DAX 40 market opens at 9 AM Central European time. Let's say our ATR is 192. At time of 9, at trading chart, I will mark the price with some horizontal dotted line to track ATR. Or you can set some alerts with triggers to keep in touch. Free of choice. Important is to track ATR from market opening time. Keep that in mind. ATR and the rules with ATR are very important and should be followed from the very beginning at your training career. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.